By setting prices at $173, the U.S. Mint has effectively aligned itself with those wagering on inflation, acknowledging that the dollar's purchasing power has weakened significantly. The soaring costs of tangible assets like silver coins mark real-time evidence of currency devaluation, underscoring how these crises unfold gradually through successive price adjustments. The silver screen might display a spot price of $90, but in reality, only the physical price holds integrity and authenticity. The paper market represents speculative contracts disconnected from tangible worth and increasingly fragile under scrutiny. While the Mint's decision serves as an undeniable wake-up call, the events taking place behind closed doors tell an equally compelling story. On Friday night, amid these developments, one of the largest single-day physical withdrawals from commercial vaults in exchange history occurred, a pivotal moment worth deeper analysis in the next segment. Let S delve into the data to highlight a staggering revelation. More than 4 million ounces of silver were withdrawn from COMEX vaults in a single trading session. What is crucial here is not just the volume of silver that vanished, but the apparent strategy behind it. The dramatic price drop to $86 wasn't engineered for profit alone. Instead, it seems to have provided cover for this massive withdrawal. By deflating the price, the orchestrators managed to withdraw the precious metal at a significant discount. Lowering the price by $6 in a short time frame equates to saving approximately $24 million when withdrawing 4 million ounces. The U.S. Mint had already updated its website to reflect an unprecedented $173 price per ounce, signaling a clear departure from usual valuations. Meanwhile, under the radar, a different narrative unfolded in the darker corners of the financial world. On Friday, January 16th, we analyzed daily warehouse reports from the CME Group, which are typically mundane and predictable, recording small-scale movements in and out of vaults, a few thousand ounces here and there. But this particular Friday told an entirely different story. The report revealed an extraordinary withdrawal of over 4.2 million ounces of silver, a volume equivalent to 130 metric tons, in just one day. To provide some context, this isn't the work of casual investors or small-scale purchasers. This is industrial-scale movement. Fleets of armored trucks, or even a cargo plane, would be required to transport such an enormous quantity. It was nothing less than a calculated and coordinated operation, systematically targeting every major custodian within the COMEX network. Breaking down the withdrawals, the data shows that 1.4 million ounces came from the Asahi Depository, 1.22 million ounces from CNT, another 1.2 million ounces from JP Morgan's vault, and nearly 800,000 ounces from Manfra, Tordella, and Brooks. This wasn't an isolated incident, but rather a synchronized raid across multiple vaults, coinciding conspicuously with the moment COMEX prices were pushed down to $86. Could such a sharp price drop just before massive silver withdrawals be viewed as a coincidence? Unlikely. It points towards deliberate market manipulation, a strategy designed to artificially suppress silver prices in order to fulfill withdrawal needs at steep discounts. For those looking to take out millions of ounces, this sudden dip translated into substantial cost savings, a hallmark of what can only be seen as an orchestrated heist. Even more alarming than the volume withdrawn is what S happening to registered silver inventory, the portion of silver in COMEX that S explicitly available for delivery against futures contracts. On that very same Friday, registered inventory plummeted by over 2.5 million ounces, declining to just 120 million ounces. This inventory serves as a safety margin for market liquidity, and its rapid depletion signals profound stress in the system. Such a drop indicates that owners, banks, and trading institutions are pulling their silver from public availability, retreating into private vaults. Why? They foresee what's on the horizon. There's mounting evidence that U.S. government measures like the Trump proclamation and Section 232 investigation into critical minerals could drastically alter silver's standing on international markets. Possible moves like declaring silver a critical mineral, imposing price floors, or implementing export restrictions make it strategic for institutions to relocate their holdings, potentially out of public vaults or even out of the country entirely. It stands to reason that a significant portion of these 4 million withdrawn ounces is being redirected to other markets like London or Shanghai. Reports suggest that the London Bullion Market Association, LBMA, is facing its own severe shortages, compounded by the arbitrage gap with Shanghai aggressively draining supply from both London and New York. The financial system feels increasingly like a game of survival, where banks siphon metal from dwindling supplies in one location to patch gaps elsewhere. With liquidity disintegrating, we're witnessing a convergence of crises. The public vaults are being emptied, transferring wealth into private reserves in what appears to be the final act of this commodity squeeze. This all ties back to the glaring disparity between the paper and physical silver markets. While COMEX suggests silver's paper price hovers near $90 an ounce, Physical inventory is being liquidated at rates suggesting resource depletion could reach catastrophic levels soon. If withdrawals persist at 4 million ounces per day, registered inventories will completely run dry in roughly 30 trading sessions, coincidentally aligning with March S silver delivery month, historically one of the largest delivery periods for this precious metal. Simply put, the clock is ticking. The foundations propping up this market are crumbling rapidly. The exit doors are narrowing as physical silver slips away towards private hands or international storage facilities, leaving market participants with diminishing options and rising uncertainty about what comes next in this high-stakes game of supply and demand manipulation. The most recent open interest data reveals that traders are increasingly opting for delivery in unprecedented numbers, rolling contracts backward to secure metal immediately. However, there is a looming issue. If banks exhaust vault reserves in January and February to send silver to destinations like China, March could bring a crisis with nothing left to deliver. This sets the stage for a potential force majeure scenario, where the exchange admits it cannot meet its obligations and offers contract holders cash value instead of silver. But for industrial buyers, cash settlements don't suffice. They need physical silver. Friday night's vault activity wasn't just routine, it signaled something deeper. Insiders appear to be cashing out while they still can, pulling their assets from the table as warnings grow louder for retail investors. Banks are claiming physical silver, government sales are being suspended, and vault inventories continue to diminish. If major global players are scrambling to secure physical assets rather than relying on paper claims, it raises the question, why should retail investors hesitate? This isn't a T merely about rising prices. It's about the threat of physical silver becoming completely unavailable. Examining recent trends, retail investors were also making waves while institutional forces drained the vaults. Data from the Kobeck letter confirms retail buyers have been purchasing silver ETFs consistently for 169 days straight, an all-time record streak. The intensity of this buying craze aligns with historic proportions, doubling recent averages and even surpassing activity seen during the 2021 silver squeeze. Unlike the flash mobs organized via online communities back then, this shift reflects a deeper migration of capital, from stocks and bonds to hard assets. Yet, amidst this frenzy lies a critical misstep. Much of the retail investment is flowing into silver ETFs like SLV. Many assume these purchases equal owning physical silver and removing it from circulation when, in reality, they were buying trust units backed by claims on silver stored in vaults managed by heavyweights like JP Morgan, a key player that simultaneously liquidating its own reserves. With this glaring conflict of interest, investors inadvertently support practices that undermine their own positions. The deeper issue lies within major bank holdings, particularly at institutions like Bank of America and Citigroup. Reports suggest these banks are entangled in colossal derivatives positions, with some estimates placing their gross short exposure in precious metals as high as 4.4 billion ounces, equivalent to 5 years of global silver production. Now, these banks find themselves cornered. On one front, retail momentum drives up prices as billions flood the ETF market. On the other, institutional investors, whales, continue depleting physical inventories, stripping away essential collateral. This collision of forces paints a grim picture for paper markets and Silver S availability for years to come. They are caught in a vice. If the price of silver rises to $100, the losses on a 4 billion ounce short position would be catastrophic. It would wipe out the equity of the banks. It would require a Federal Reserve bailout larger than 2008. This explains the violence of the price action. This explains why they smashed the price to $86 on Thursday. They are fighting for their lives, but the retail swarm is relentless. 169 days of buying proves that the public is not selling the dips. They are buying the dips. Every time the banks smash the price, the ETF inflows accelerate. The banks are trying to scare the public out, but they are only inviting them in at a better price. This is the unstoppable force, meaning the immovable object. The unstoppable force is the inflation-fearing public. The immovable object is the insolvent banking cartel. Something has to give, and based on the vault data from Part 2, the thing that is giving is the physical inventory. The ETF structure acts as a buffer. It absorbs the retail demand and keeps it away from the physical market for a while. The authorized participants can use leasing and accounting tricks to satisfy the ETF rules without actually moving metal, but they cannot do it forever. Eventually, the disparity becomes too large. If SLV says it holds 500 million ounces, but the vaults are empty because the silver went to Shanghai, the ETF implodes. We are approaching the moment where the paper claims exceed the physical atoms by a ratio that triggers a default. For the individual investor, this data carries a stark warning. If you're part of that 169-day streak and you're holding SLV, you are sitting in the danger zone. You're holding a receipt for a car that has already been stolen. When the squeeze finally breaks the banks, the ETFs will likely be settled in cash. They will give you dollars, but you don't want dollars, you want silver. The retail swarm has the right idea. Buy silver, but the wrong execution. They are buying the map instead of the territory. This massive inflow of capital proves that the sentiment has shifted. The public is awake. They know the dollar is dying. They know inflation is lying, and they are voting with their wallets, but they are voting in a rigged ballot box. The Friday night heist we discussed in part 2 was the smart money taking the physical metal before the ETF holders realize it is gone. So where does this leave us for the Monday open? We have a market where the price is $90. The mint is at $173. Shanghai is at $12, and the banks are short 4 billion ounces. This is a powder keg. The retail buying is the fuse, the vault drain is the spark, and the explosion will be the repricing of silver to a level that balances the books. That level is not $90. It is not $100. In the final part of this deep dive, we are going to look at the verdict. We are going to combine the mint pricing, the vault drain, and the short position to calculate the true target. We are going to discuss the Monday gap. With all this news breaking over the weekend, the US mint repricing, the vault drain, the market is likely to panic at the open. And we are going to give you the final strategy for navigating the great repricing. The banks are trapped. The public is swarming and the metal is gone. The only way out is up. We have arrived at the conclusion. If you have been with me through this forensic investigation, you now possess a picture of the market that the mainstream media refuses to show you. You understand the sovereign leak where the US Mint admitted the real price is $173. You understand the Friday night heist where 4.2 million ounces were looted from the vaults. And you understand the retail swarm that has trapped the banks in a 4 billion ounce short position. The evidence is overwhelming. It is not a theory. It is a mathematical disconnect that cannot be resolved without a massive repricing event. Today, Saturday, January 17th, 2026, we are staring at the largest pricing anomaly in the history of finance. Look at the numbers one last time. The spot price on the COMEX closed at $90.14. The Shanghai price closed at $12. The United States Mint price is effectively $173. The gap between the paper price in New York and the sovereign price at the US Mint is 83. That is not a spread. That is a chasm. That is the Grand Canyon of financial risk. If you can buy a silver for $90, that represents an asset the government says is worth $173. You are looking at the trade of a lifetime. You're buying dollars for 50. But this anomaly will not last. Markets abhor a vacuum. Physics demands equilibrium. There are only two ways this gap closes. Scenario 1, the US Mint is wrong. The shortage is fake. The 4 million ounces return to the vault and the price crashes back to $90. Given the data we have analyzed, the inelastic industrial demand, the depleted mines, the retail hoarding, this scenario is impossible. The metal is gone. It is not coming back. Scenario 2, the paper price on the COMEX gaps up to meet the physical reality. This is the only path forward. The paper price is a lagging indicator. It is the last thing to move. The physical price leads. The Shanghai price confirms, and eventually the paper price capitulates. We are setting up for a Monday morning shock. While the markets are closed this weekend, the news of the US Mint repricing is spreading. The news of the vault drain is spreading. Investors around the world are doing the same math we just did. They are realizing that $90 is a gift. When the markets open in Asia on Sunday night and in New York on Monday morning, we expect to see a rush for liquidity. We expect to see traders trying to front or run the US Mint. If the government thinks silver is worth $173, then $95 is cheap, $100 is cheap, $120 is cheap. This creates a buying panic that overrides the bank's suppression algorithms. So what is the verdict? The verdict is that the great repricing has begun. The eras of double-digit silver is effectively over in the real world, even if the screen hasn't caught up yet. The verdict is that the banks have lost control of the physical inventory, which means they have lost control of the price. They can print paper, but they cannot print metal. And the verdict is that we are witnessing a wealth transfer from those who trust the screen to those who trust the scale. So what is your strategy? How do you navigate this chaos? Rule number 1, do not sell your physical metal. I know the temptation will be strong. If silver hits $100 next week, you will feel rich. You will want to cash out, but remember the US Mint price. If you sell at $100, you're selling at a $73 discount to the government's own valuation. You're getting ripped off. Do not trade your scarce asset for a dying currency. Hold until the paper price matches the street price. Rule number 2, ignore the volatility. The banks are wounded, but they are not dead. They will try to smash the price again. They might try to drive it down to $88 to trigger stop losses. If you see a red candle on Monday, laugh at it. It is a fake signal. It is a paper game. The real game is played in the vault, and the vault is empty. Rule number 3, watch the spread. The most important chart right now is not the price of silver. It is the difference between the spot price and the physical price. As long as that spread exists, as long as the mint is higher than the conks, the bull market is intact. The squeeze is active. We are watching the collapse of a 50-year scheme to suppress the price of real money. It is messy, it is volatile, it is terrifying, but it is also the greatest opportunity of our lives. The United States government just tipped its hand. They told you what they think silver is worth. They told you it is worth $173. Believe them. The banks are short, the mint is closed, the vaults are empty, and the price is $90. You know what to do.